Hello investors, this is Kritesh from TradeBrains, and in this video I am going to explain how to do fundamental analysis on stocks, so stay tuned. First of all, if you are new to this channel, please subscribe to view more interesting videos on stock market investing. Now, fundamental analysis of a stock is used to determine the health of a company. It's recommended to do a proper fundamental analysis of the stock before investing if you are planning for long-term investment. Technical analysis is good to find the entry and exit time of stock for intraday or short term. You can book good profits using the technical indicators. However, if you want to find a multi-bagger stock to invest, then the fundamental analysis is the best tool that you can utilize. In this video, I am going to explain how to do fundamental analysis on stocks. Here I will state 6 steps that will help you to select fundamentally strong companies. Step 1. Use the financial ratios for initial screening. There are over 5,000 companies listed in the Indian stock market. If you start reading the financial of all the companies, then it might take years. For the initial screening of the stocks, you can use various financial ratios like P/E ratio, P/B ratio, compounded annual growth rate, ROE, current ratio, dividend yield, etc. For this stock screening using financial ratios, you can use different financial websites like investing.com, screener.com. How to do screening of stocks using investing.com? Step 1. Go to investing.com website. Step 2. From top menu, select tools, then go to select stock screener. Step 3. Select the financial ratios and edit criteria. For example, if you want P/E ratio between 5 and 18 and dividend yield percent between 1 to 3, you can select the following criteria. Screener will shortlist the stocks according to criteria mentioned. Further, you can also add a number of financial ratios in your criteria like CAGR, ROE, P/B ratio, etc. Step 2. Understand the company. It is important that you understand the company in which you are investing, because if you don't, you won't be able to decide whether the company is performing good or bad, whether the company is taking right decision towards its future or not, whether you should hold or sell the stock. A simple way to understand the company is to visit its website. Go to company's website and check its about, product, promoters, board of directors page. Read the mission and vision statement of that company. If you are able to understand the products and vision of the company and find it attractive, then move further to investigate more. Else, ignore the company. Step 3. Study the financial reports of the company. Once you have understood the company and found it appealing, you can check the financials of the company like balance sheet, profit loss statement, cash flow statements, etc. As a thumb rule, compounded annual growth rate, sales and net profit increasing for the last 5 years can be considered a healthy sign for the company. However, you need also to check the other financials like operating costs, revenue, expenses, etc. The best website to check the financial statements of a company that I most frequently use is Screener. Here are the few steps to check the financial reports of a company. Step 1. Go to Screener. Step 2. Enter the company's name in search box. Step 3. Check the annual results. You need to study the financial of a company carefully to select a good value or growth stock before investing. Step 4. Check the debt. Company's debt is one of the biggest factors to check before investing in a company. A company cannot perform well or reward its shareholder if it has huge debt. In short, avoid companies with huge debt. As a thumb rule, always invest in companies with debt to equity ratio less than 1. You can use this ratio in the initial screening of the stocks, or else check the financials on the Screener website. Step 5. Find the company's competitors. It's always good to study the peers of a company before investing. Determine what this company is doing that its competitors aren't. Further, you should be able to answer the question that why you are investing in this company and not any of its competitor. Why are you selecting Maruti Suzuki over Tata Motors? The answer can be anything convincing like the company's unique selling point, future prospects, upcoming projects, new plans, etc. You can find a list of the competitors of the company on the Skrindo website itself. Just enter the stock name in the search box and navigate down. You will find a peer comparison there. Study the details about the competitors minutely. Step 6. Analyze the future prospects. Always invest in a company with a long future prospects. Select only those companies to invest whose products or service will still be used from 20 years from now. There is no point in investing in a CD or pen drive making company with no longer prospects. If you are planning to invest for long term, then the long life of company's product is a must criteria to check. Summary. Here are the 6 steps on how to do fundamental analysis of stocks for the beginners. First, use the financial ratios for initial screening. Second, understand the company. Third, study the financial reports of the company. Fourth, check the debt. Fifth, find the company's competitors. Sixth, analyze the future prospects. That's all for today. I hope this video is useful for the viewers. Don't forget to download the free ebook on how to select a stock for consistent returns. The link is given in description. Further, if you like the video, please give a big thumbs up and subscribe to the channel for more interesting investing videos. This is Kritesh signing off.